I woke up this morning to a headline on Twitter that says Mark Zuckerberg is set to resign from Meta platforms next year. I was in complete shock. How could this possibly be true? I mean, he only just started working on the metaverse, a 10+ year venture. For God's sake, he just changed the name of the company to pursue this new virtual reality hobby. The leak from, well, the leak says their inside source at Meta confirmed the plan for Zuckerberg to step down in 2023. And as soon as I saw that, I thought to myself, there's no way this could be true. And it's not. It's fake. Well, I mean, it's not fake, it's not satire, but it's probably complete garbage. And this is the case because Andy Stone from Meta quickly denied the claim made by the leak's anonymous source. And given that the metaverse is Zuckerberg's new baby, there's absolutely no reason to believe this until we see further evidence, but that's actually not the best part of this story. For the few hours where this story was circling around Wall Street, Meta stock started going up. Meta stock has basically been in free fall since the middle of 2021, and there's something really funny to me about the idea that investors got excited for 5 minutes that maybe Meta is going to slow the rate at which they destroy one of the most successful companies of all time. But all jokes aside, it is kind of crazy how much traction some of these baseless stories can get in the media and in the finance space. I mean, the article has absolutely no evidence besides their anonymous insider source, and Meta themselves denied it immediately. Yet the article is still on top of the front page of the leak's website. And it just makes me realize what a strange time we live in at the moment. I mean, we have so much access to so much information, which means that we are, I think, a lot smarter, I guess, in some ways than previous generations, at least just through the information we have access to. But we also have immediate access to way more lies than before. And you can find arguments to support pretty much any argument you want. And you can just test this by going on Google and just Googling the argument for both sides. And you'll probably find information that supports both sides. Like, let's say, does chocolate cause headaches? Oh, okay. It does. Does chocolate fix headaches? Oh, it does that too. But anyway, back to Zuckerberg. If you ask me which CEO out of the biggest companies in the US is most likely to still be CEO at that company in 10 years, Zuckerberg would be the first name that came to mind. So not only do I not think that Zuckerberg is leaving next year, I think he's probably one of the few CEOs that will still be in place in large companies because most of the time CEOs change relatively quickly. And my main reasoning for this, besides the fact that he's clearly hyper-focused on the metaverse, which is something that won't be widely used for many years and is going to take a lot of work on his behalf to get it up and running. But besides that, it's that he still owns 350 million Class B shares. Now, these are not Class A shares, which you and I can trade on the stock market. These are Class B shares that are not publicly traded and are only owned by Mark Zuckerberg. And these shares are pretty similar to A in some ways and very different in others. In terms of ownership, they are exactly the same. So they both represent one share of ownership, and B class shares can be converted to the same amount of Class A shares at any time. But the main difference is that Class B shares have 10 votes each on them for proxy meetings compared to 1 vote each on Class A shares. So in other words, his Class B shares are worth 10 times the votes of typical shares that you can buy on the public markets. And all of this is to say that even though he only owns 15% of the company, Mark has 54.4% of the voting power. And by having more than 50%, it means that even if every single shareholder voted against him, he couldn't be removed as CEO from the company. And whether you like Mark and the huge amount of money that he's spending on the metaverse probably gives you an indication of whether you think that is a good thing or a bad thing. I mean, I don't own Meta stock anymore. I used to, I don't anymore. And I honestly have no idea how this metaverse stuff is going to play out. I'm super excited about it, but I have no idea what it's going to look like. But if I personally like a CEO and I like their long-term vision, I kind of like the idea that they can't be removed by institutional investors who want to force change within the company in a direction that I don't agree with. What I mean by this is it's extremely common for a CEO to be forced out by activist institutional investors who want the company to stop investing for the future and just to start producing profit today and delivering that profit to shareholders. And the reason they want that is because they care about their investments and how those stock prices perform over the next 6 months, next 12 months at the most. And that flies in the face of what great businesses need to do, which is often they need to sacrifice profits today to invest and build the deep competitive advantages that sustain those businesses, not over just a decade, but over multiple decades. A really good example of this is Costco, right? Costco has chosen to sacrifice profits today in the pursuit of maintaining their deep competitive position. And they do this by having a fixed gross margin of 14 to 15% on their goods. Now, of course, as Costco has scaled, their cost per unit has gone down. So even if they just kept their prices where they were, they would be able to take additional profit. But instead of even doing that, they continue to lower their prices, keeping that margin fixed. And that essentially means they sacrifice profit today because customers are willing to buy products at those prices today. They don't have to lower those prices, but by doing it, they solidify their moat as a business that cannot be beaten on price. A business that can take advantage of scale economics and collect more profit without having to raise their prices because their costs are going down per unit, that's a great business. An incredible business is one that solidifies that advantage by also delivering that additional economic benefit to their customers in the form of lower prices or an improved service. But let's change pace and talk about some other CEO news that is certainly not fake news, and that is that Bob Iger is back at Disney. Yes, that's right. Bob Iger is set to return as CEO of the Walt Disney Company effective immediately. And the best thing about this story is not that Disney will change strategic direction or that they'll become a better company or that they'll pay more dividends. The best thing about this is all of the headlines that are coming out about this announcement. Plot twist, prodigal son returns. Disney's Mr. Fix-It returns. Oh, and my personal favorite, Return of the Jedi brings Disney a new hope. I swear I need to hire some of these people just to write my YouTube titles. The press release from Disney stated that Bob Iger has been appointed CEO and would be returning effective immediately. Iger, of course, was the CEO of Disney for 15 years up until 2020 and has been responsible for some of Disney's biggest success stories, including the acquisition of Pixar, Lucasfilms, Marvel, and even the 20th Century Fox merger. And on top of all of that, it was actually Bob Iger's vision to move Disney into streaming far before many of the other legacy media companies decided to. Disney Plus launched in 2019, and Disney already had owned 66% of Hulu, which has been around for over a decade. Bob Chapek, who was the CEO since 2020, has of course been fired. And Chapek has been getting and likely will continue to get a lot of criticism about the performance of Disney's stock price this year and the fact that their streaming business is still not profitable and that it's weighing down the profits of the company. It's kind of affecting the hugely profitable conglomerate that Disney once was. But honestly, he seems to have done pretty much exactly what Iger wanted him to do in terms of streaming, and he also did what seems to me was the only thing that he could do, which was to spend a ton of money to try and get streaming profitable. Because as it currently sits, Disney's profits are heavily supported by revenue from their cable networks. And their cable revenue will very likely be almost entirely going away over the next decade. So it's kind of a race for these legacy media companies to spend a ton of money on content, attract subscribers onto their streaming platforms to get to a large enough scale where they are profitable to spend their typical amount on content spend, right? Because before they were collecting these huge cable streaming revenue streams and they were able to spend huge amounts on content, but can they support the huge amount that they spend on content with a smaller subscriber base, or not a smaller subscriber base in Disney's case, but subscribers who are paying far less than they previously would? Iger, in a memo to staff, said that Disney was going to undergo restructuring over the next few weeks. He said there will be a new structure that puts more decision-making in the hands of creative teams and rationalizes costs. My interpretation of that is that Iger is probably going to look to sell or spin off some parts of the media conglomerate to solidify where Disney wants to focus going forward. But how that looks for their streaming business going forward, I have no idea. When he says rationalizing costs, that seems to suggest that maybe they're going to rein in some of their content spend in a similar way that Warner Brothers announced that earlier this year. But honestly, I don't actually know how they continue to grow their streaming platform if they now decide to cut back on content. It may be entirely possible that Disney goes a similar route to Warner Brothers where they're going to subsidize their unprofitable streaming platform by continuing or increasing the amount of licensing and selling of content to Netflix and other platforms. But really, only time will tell. This only has just been announced today, so we will see what strategic direction Disney takes, especially over the next few months. If you want to hear my deeper thoughts on Disney or Netflix and how I've analyzed these other streaming platforms and other media companies, then you can access all of it by becoming a member of our investor community. And hey, it costs less than a streaming subscription. So why not do that instead of subscribing to watch Disney princess movies?